Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for August 10th, 2020. Please see our disclaimer for important information. So we're going to start off with a quick view of the S&P 500 this week. We're roughly about 2% from an all-time high, and this is a chart that kind of goes back through the beginning of the year and kind of brings us up to speed on what happened with the pandemic. You can see the increase in daily volatility there at March, and March 23rd was our low. Now we have battled back, and as you can see, really tracking certainly over the last month, you can see that volatility really going down on the daily on the daily activity, and that's depicted by the length of those bars on trading days. And as they become more narrow, that means the volatility is dropping. And that's been a fairly profound development here over the last several months. So as we look at the market, it's helpful to kind of look at the derivation of the returns. If we go back several years in this slide with data from Bloomberg, we can see that there are different things afoot with regard to the pace of the market. And so we know as practitioners that S&P 500 index returns come in a variety of ways. Now you can have dividend income, which we know has historically generated about 40% of stock returns over a long period of time. We can have multiple expansion, which is meaning the price to earnings multiple expansion. Basically, stocks become more richly valued over periods of time. And you can have earnings growth. And we know that earnings for companies that are in the index are kind of the mother's milk for long-term expansion. As we know that earnings typically go up over long periods of time, and they have the propensity of going down very violently as they have this year. But as you look at 2016, just as a starting point, you can see that there's roughly equal contribution from both price to earnings multiple expansion as well as earnings. And then we have a little bit of a dividend boost, and so total return for 2016 was just over 10%. And then if you look at 2017, you had a little bit more contribution from earnings, but you still had multiple expansion. So the return for the market in 2017 was actually fairly strong. It was over 20%. So we got into 2018, we had a fairly strong year in terms of earnings growth, almost too strong, in fact. But we also had multiple contraction. If you remember 2018, we had turbulence on both sides of that year, both in the beginning of the year when the market got ahead of itself and had corrected, and that was right after the tax law was enacted. A lot of turbulence and speculation going on there. And then towards the end of the year, we had a lot of volatility and a very difficult time in the market. So we actually had PE multiple contraction, which kind of took away from total returns. And we were actually negative in total return in the S&P 500 index for the year. As we get into 2019, we had a fantastic year for stocks. Returns were over 30%, but most of that came from PE multiple expansion. And as you can see in that little thin kind of grayish blue line there, what that represents is earnings beginning to slow, earnings growth beginning to slow. And so in 2019, the contribution of earnings to total index growth actually fell dramatically from years prior. And it was at that point towards the end of last year that practitioners like us that were observing this contraction in earnings were beginning to layer in some protections and portfolio insurance, if you will, to try to help cushion a downturn. Of course, not realizing that we were stepping headlong into a pandemic here this year. So as you can see this year, the returns after a fairly dramatic fall and a fairly dramatic rise in the aftermath of the naming of COVID-19 as a pandemic, we've had a significant contraction in earnings, but as is fairly typical in a recessionary type of environment where you have a faster drop in earnings than you do in prices, you tend to get a multiple expansion, which is actually what's happened this year. So, companies have slashed their dividends, so you're getting less contribution from dividend into total return, but we're slightly positive primarily because we've had more multiple expansion with the declining earnings base. So, and some of that is actually kind of depicted here. So the blue line is basically the S&P 500 index over a multiple of years. And then the kind of that orangish or gold kind of colored line is basically profit margin for the S&P 500. And as you can see, if going back to basically the beginning of 2014, you can see kind of a fairly loose, not terrific, but a positive correlation between profit margins and stocks. It's not perfect, it's not a strong correlation, but you can see that there's a decent relationship there. And you can see that kind of that cathartic move that we had in February with the advent of COVID-19, and you can just see how much the profit margin was impacted. As you can see that little hook, as you look at the right side of your screen, profit margins are coming back a little bit, but there's a huge disconnect between the drop in profit margins and even the magnitude of this very nascent recovery in margins that you can see there, and what's going on in the stock market. And I think that's going to be very interesting. And as you can see, going back to 2014, there really isn't a precedent for a dislocation quite this large. Stocks were going up dramatically at a point where even before there was a bottoming out in profit margins. So have a couple of update charts here, things that we're monitoring. Obviously, there's a lot of noise in the data right now, and I think we're beginning to see, some of this kind of systemic fallout. And this chart shows you bankruptcies, and there's two charts on here for a reason. Now, on the left-hand side, the chart from Bloomberg with the black backdrop shows you the number of U.S. bankruptcies through July for 2020. We've had like 160, I believe this is 160,000. And these are Chapter 11 and 7 filings for both public and private companies with liabilities over 50 million. So, I mean, these are decent sized companies. This is not small business here by any stretch. But the point is that we've got the bankruptcy rolls are as good or as high as they've been since 2009, and we all know what happened back then. Now the chart on the right, it shows you the number of monthly bankruptcies for companies with 500 million, and these are larger companies. And so what's interesting is, with all the very important and very apt speculation about what's going on with small business, we don't want to lose sight over the fact that there are large companies that are struggling in this environment, and that's what these two charts show you. So you've got large businesses on the left, we're back up to 2009 highs, and the charts on the right, which only go back, basically to July of 2018, but it shows you the aggregate numbers themselves are not nearly as important as a trend line. And what we're seeing here is that in July of 2020, relative to January, the monthly bankruptcies for companies with extremely large balance sheets are going up fairly stoutly. So as we kind of take a step back from the large company side, let's look at small company impacts. And I think this chart does actually a really good job of illustrating that. This is a continuing unemployment claim. This is not the information that you get every Thursday that's being released as far as new unemployment claims. These are the continuing claims, and you can see the aggregate number is fairly profound. It's 30 million. These are 30 million continuing claims every week. But what is telling you this is not the number itself, which is kind of jockeying up and down and kind of around that $30 million level. It's the derivation of these. And so, there's a big difference between the kind of this grayish blue and then the pink area in this chart. So the grayish blue represents the conventional, the conventional continuing claims for state reported data. And this is the continuing claims data that you see at the end of the press release when you get that weekly new unemployment claim number. And so that number is going down. That's good. And we like to see that. So those are people that were previously employed with a company that was paying unemployment insurance, and so obviously now people are getting benefits from that those payments into the unemployment insurance coffers. But on the top is the pink, and those are the PUA claims. And what is a PUA? Well, there is actually some notes down at the bottom of this, but these are basically self-employed people that could not get traditional state-sponsored unemployment insurance. Basically, the people that couldn't qualify for that grayish blue. These are self-employed solopreneurs that work out of their house. They may work in co-working, but these are the solopreneurs, and you can see that there's been a fairly dramatic rise in the number of continuing claims attached to that cohort, and that's really telling that, and this really does speak to the impact, the growing impact throughout the last several months on small business, and it will definitely be something that we want to monitor continuing to go forward. So again, more update charts. Here's a chart quickly on crude. Now these are days of supply on hand, and we all know that there was massive demand destruction earlier this year. We had the front end futures contract for crude oil actually go negative, which is not happened, I don't believe, in my lifetime, but that happened earlier this year. Inventory shot through the roof, as you can see on that blue bar. The kind of that goldish color, that was last year's activity. And typically when you get into June through July and August, the summer months, you have the driving season. You typically have a pickup in demand, and supply typically drops. Now that's happening again this year, but it's coming off of a higher base of supply. And we know that if we can drive more demand from economies opening up and kind of getting our handle on this pandemic and beginning to reestablish our economic growth, you'll continue to see that go down. But I just say it's at least positive in the sense that it's tracking a seasonal pattern and perhaps maybe even a little bit more accelerated relative to a year ago. So we're going to spend a few minutes here talking about interest rates, and we're going to start with the 10-year U.S. Treasury. And we know just basically in general, we've seen a dramatic drop in interest rates across the board, across the entire curve. But there's a couple of read-throughs on this. And on the left-hand side is the yield itself. It's the nominal yield. And right now that yield on the 10-year Treasury is about half of 1%, or what we call 50 basis points. Now, back in March, at just the pinnacle of panic, we saw that hit an all-time low, which was lower than that. Still positive, but it was lower than that. Well, we're getting back closer to those levels, and that's important because interest rates have, really don't have that much farther to fall without going negative. We know the Fed does not want to have negative interest rates, but on the right-hand side is actually the real yield on the Treasury. And what does that mean? That just means it's that 0.5% nominal rate less inflation. And right now, as you can see on that black backdrop chart on the right, over on the far right-hand side, we're basically at negative 1.1% yield, real yield on the 10-year Treasury. And we've never been that low before. That's very profound. And this is actually having a very positive impact on gold, which we're going to talk about in a couple of minutes. But that negative real yield is fairly important in terms of the market trying to identify pockets of value. So it's very important to consider that we have such a strong negative real yield right now, because that has implications for savers. It has implications for a lot of things. And in the next chart, we'll talk about why that number is going down at a much faster rate than interest rates. So this is the U.S. 10-year Treasury break-even rate. So what does this number represent? It basically, in the chart previously on the left-hand side, we had we had the nominal Treasury rate of 50 basis points, or half of 1%. And then on the other side, we had the real yield, which was down basically 1.1%. So the difference between those two numbers is this. It's the break-even rate. So this is the Treasury inflation protected security implied inflation rate. So basically, the market determines this price, and it's just simply the difference between the nominal yield on a 10-year Treasury that you could buy today and what the market believes is the 10-year, basically the long-term inflation rate. And as you can see here, it's about 1.6%. And that gets us back close to where we have been for a while up until really the beginning of this year. And so that's important to consider that interest rates, nominal interest rates, are very, very low. They have, they can't really fall that much farther, like I said, without getting negative, but yet we're getting back to expected inflation rates as determined by the market of like 1.6, kind of back to where we were. So what this implies is that we're going to have negative real yields on interest rates for quite a while, because the Fed is not inclined to want to raise interest rates now. They're spending a lot of effort to kind of keep rates low and almost be an arm of the Treasury that's spending most of its time trying to monetize our debt. So I wouldn't expect a nominal interest rate rise of any significant magnitude for a period of time, but yet the inflation expectation number has gone up as you look out on the horizon. I do think that this is relevant because I do think that after a period of disinflation, we are going to begin to see some inflation on the horizon. So let's talk about gold. Last week we had some charts kind of talking about the aggregate price of gold and its action, but I want to take a look at this again here. So basically spot gold prices are depicted in the black line, and then that's plotted against the S&P 500 index. So as I've mentioned, the interest rates don't have much farther to fall, and lower interest rates, the implications there is that the income advantage of bonds versus gold is shrinking. And so what you're seeing are more investors, kind of sophisticated hedge fund types, that are increasingly using gold bullion as an inflation link debt to balance equity risk in place of bonds. And so gold is kind of taking on a new role here because yields on bonds are very, very low, and but essentially Treasury yields are chiefly driven by expectations for Federal Reserve policy changes and inflation expectations, and gold does not have that anchor. And gold prices are typically much more sensitive to investor positioning than treasuries, which kind of means that gold may move in closer step and in correlation with stocks, which really, as in the traditional view, kind of defeats the purpose of using gold as a hedge against stocks. So the unintended consequence of having more investors begin to use gold as a proxy for diversification to bonds may have the unintended consequence of having gold actually be tied closer to equities. And again, a few months does not a trend make, but you can see here that there's kind of a tighter correlation, if you will, in 2020 of gold to stock prices. And I think this is kind of an interesting thing to watch, because I do think that with the continuation of a weak dollar, and as we've just talked and discussed in the last couple of slides, the expectation that we're going to have negative real yields on treasuries for the foreseeable future, that this parity, this relationship could remain fairly strong, and that we could continue to see continued lifetime of gold despite this rally today. So as we kind of bring you up to speed on some of the information out here, this is the services, the Institute for Supply Management Services Purchasing Managers Index. On the left-hand side, it's the raw index, which is basically services account for the majority of our economy. Manufacturing is another component, but manufacturing, as a percent of our economy is maybe, it's well below 15% now. So services mean a lot more. And it's good to see that number is picked up. In fact, it's kind of picked up to kind of really a trend line level after having fallen dramatically in the wake of the pandemic. On the right-hand side of this particular slide, you see the new orders index, and that's really shot up. I think, with all the noise in the economy and all the high frequency data that we've got, and I've got a table of that coming up, what you can see is that the new orders are picking up very nicely, very healthy sign. And here is that chart of high frequency data items that is published by First Trust. There's no attribution at the bottom of this page, but this is accumulated and published by First Trust out of Chicago, some good partners of ours. So basically the read through on this, if you look at the two right hand columns, what you want to see is an abundance of green, and you actually do. So if you look at jobless claims, those have been down both in the last month over month and the last week over week. Jobless continuing claims, which on this number the level is 16 million. So that represents that kind of bluish gray in that chart that we showed you before. It doesn't include that PUA or the self-employed people, but nevertheless those numbers are going down. That's good. Staffing numbers are going up. Box office receipts are coming off of a fairly low base, but you can see that even as movie theaters open up, those are improving. Importantly, rail car traffic and steel production are going up, and fairly strongly on a month over month basis. And then hotel occupancy and daily rates, and then revenue, or RevPAR, which is revenue per available room, those are all going up. So there's more traveling going on. Now we know business travel is going to take a while, but at least you've got some positive movement in the hospitality. Restaurant industry data is picking up there, as well as a TSA checkpoint. And I wouldn't worry too much about the gasoline numbers, which have by and large been trending up, but there can be a lot of noise week over week in that data. So on balance, good data out of high frequency. So when will a vaccine become widely available? This is a survey of healthcare industry leaders to the question, when will it be available, on a fairly wide basis. And you can see the distribution of information. Again, trying to condense all the noise and the and news flow and social media into something that kind of gives us something to look forward to. And this is relevant in terms of the health of the stock market. It's relevant in terms of the health of the economy. And you can see that, that these healthcare professionals, only 1% believe that we're going to get a vaccine by the fourth quarter that's going to be widely available. A quarter say it's going to be available in the first half of 2021. And then you get a much larger number that said it's going to take until the second half of 2021 for a vaccine to become widely available. So with all the speculation over progress being made in vaccine research and development, I think the people that you would expect to have particular insight into this topic are still, I think, a little bit guarded in their estimates on when we're going to have that available. State budget shortfalls. I'm not going to spend a whole lot of time on this, but this is something that's become a political football with regard to the follow-on stimulus package. Just highlight that we've got a couple of recessions here, and then we've got the COVID data that we are going to have a lot of stress fiscally at the state and local level. And this is a state budget. We know that we're going to have a lot of stress this year, and that stress is actually probably going to be worse next year. So, notwithstanding what stimulus might be available to states in the current negotiations, it's clear that next year is going to be a pinch. And if you look at basically the G in the equation that calculates GDP, which is consumption, investments, which include inventory, government spending, and net exports, that the government spending element of this is probably 10 to 11%, and it's going to be stressed next year, so we'll have to watch that. And then media spending, I found this particularly interesting because this is, I think, reflective of a kind of COVID-19 exacerbating some trends that were already beginning to take root. So this is global ad spending on a year-over-year basis. And as you look at social media online, if you keep going down the top of that list, it's all digital related media. And so those have really spiked up as advertisers know that people are online. But as you look down the chart on more of the traditional media that have been used for advertising, that those have some of those were tepid at best, or even going down in terms of newspapers and magazines. But you can see that COVID has really accelerated that trend. And I think what this chart is illustrative of is what we can look forward to in terms of where ad spending is going. And which I think in and of itself, if you look at, TV, radio, newspapers, magazines, you're going to see more financial stress in those areas because of this trend, because advertising is the lifeblood of the revenue stream for a lot of these conglomerates and standalone stations and newspapers and such. And really, I'm going to kind of give you some perspective. This is a fairly noisy chart, but I've taken some liberty in highlighting a couple of areas that we have a fair amount of deviation on. We've got basically the difference between Democrats and Republicans and what they feel is very important in deciding, in how this election is going to be decided. What's important? What are the key topics? What are voters going to respond to? And we know that in our markets, we tend to have more volatility in advance of a presidential election, notwithstanding the fact that we also have a pandemic right now. But clearly some lines are kind of being drawn. You can see the environment, which has this typical difference of opinion, but also it relates to healthcare. There's a meaningful delta there. Coronavirus, obviously, the perspective on how things have been handled differs from one party to the next. And national security, that typically is in there as well. But relations with China are in there, and I think I may have a chart next week that'll show you that at least public sentiment with regard to China has clearly gotten worse. So this is definitely going to be something that's going to be very important as we head into 2021. Well, that's really about all I've got for this week. A lot of data. Hope you've enjoyed this. You see my information there. Certainly welcome your thoughts and feedback, and hope you have a wonderful week, a safe week, and we look forward to hearing from you soon. Take care.